even with the pullback, where the price of gold is today is considerably higher than it was the last time the Fed cut rates. And the fact that the Fed is cutting rates and the gold price is going up is not a coincidence. Gold is reacting to a Fed that should not be cutting rates. Rates are too low, and the Fed is making them lower. And so the rate cuts are a mistake, and gold is clearly signaling that it's a mistake.
Peter Schiff, a longtime advocate of sound money and market discipline, explains that gold's strength today is no accident. It's a direct reaction to a Federal Reserve that has lost control of policy. Even with the recent pullback, gold remains well above its level from the last rate cut cycle. Schiff emphasizes that when the Fed cuts rates into rising inflation and record debt, it isn't stimulating growth and it's fueling a monetary mistake. Gold, he says, is acting as the truth teller in a world addicted to cheap credit. Every price uptick reflects the market's rejection of artificial money and misplaced confidence in policymakers. The signal is unmistakable. The Fed is wrong, and gold knows it first. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
We weren't on an official gold standard. Unofficially, we were, because Alan Greenspan still looked towards the price of gold as a market indicator of whether or not rates were too high or too low. And so what he told Congress was $400 gold meant he was too loose, and $300 gold meant he was too tight. And so he was kind of eyeing for around 350. And so if the price of gold stayed around 350, that would indicate to him that he had got interest rates about correct. Well, if $400 gold meant that Greenspan was too loose, what does $4,000 gold mean now? What is that saying about the Powell policy? Clearly, if 400 was represented too loose money back in the 80s, well, then 4,000 certainly must represent the same thing now. And so that's why it should have been brought up. And by the way, my last podcast, I titled it Gold Test $4,000 support. And some people might think, well, obviously it failed the test because now we're below 4,000, which is the case. We did end up falling below it this week. And in fact, gold closed below 400 today, although it did trade above 4,030 this morning. But it closed below it. As I'm speaking, we're up about 20 bucks, but we're still just below 39.50. But also, on my last podcast, when I talked about 4,000 support, I did say that it was very likely that gold would go below 4,000 and that 4,000 could be support even if the market was to go below, because I think it's going to be similar to the way we handled the 3,000 support. It wasn't like 3,000 was some line that we couldn't cross. And the same thing with 4,000. We get below it. But whenever you get below it, you are in a support zone. And just like the market never fell too far below 3,000, I don't expect it to fall too far below 4,000, nor do I expect it to stay below 4,000 for any long period of time, because that would give too many people the opportunity to buy it below 4,000. And I don't think that's going to be the case. So I still think that we're at 4,000 support, even if we're trading at 3,950. I mean, we're close enough to 4,000 to say this is where the support is. Obviously, the resistance now is closer to 4,500 because we did get up to, I think, 4,400, because we got up to like 4,380. So we didn't quite trade 4,400, and then we had the pullback. But even with the pullback, where the price of gold is today is considerably higher than it was the last time the Fed cut rates. And the fact that the Fed is cutting rates and the gold price is going up is not a coincidence. Gold is reacting to a Fed that should not be cutting rates. Rates are too low, and the Fed is making them lower. And so the rate cuts are a mistake, and gold is clearly signaling that it's a mistake.
Peter Schiff points out a striking historical contrast between the Greenspan era and today's monetary environment. Back in the 1980s, Alan Greenspan informally used gold as a financial compass. When gold hit $400, policy was considered too loose. At $300, too tight. Schiff argues that if $400 gold once signaled excess liquidity, Then $4,000 gold today exposes just how distorted policy has become under Jerome Powell. Despite recent pullbacks, Schiff insists that gold remains firmly supported near $4,000, behaving much like it did at $3,000 before breaking higher. The current rally, he says, is gold's verdict on the Fed's mismanagement, a clear market message that rates are still far too low and inflation control remains an illusion. Let's get into the interview.
Now, I agree with what Powell said. Yes, the problem is prices went way up and they never came down. But whose fault is that, right? Why doesn't Powell, or why doesn't somebody ask Powell, okay, then why are you targeting 2% inflation? If you admit that prices came way up and they never came down, why don't you target falling prices, right? Why can't the Fed pursue policies to bring prices back down? Because that's what the public wants. Why can't they get it? Because remember, right, when inflation had been too low, according to the Fed, right, it was below 2% for a few years. The Fed said, oh, no, we need to average this up, right? Inflation's been too low. We've been below 2%. We need to average it up to 2%. So we need to run monetary policy a little hot because we need to make up for all the years where inflation was lower than 2%. Well, if you admit that people are pissed because prices are so high and inflation was way above 2% for so long, why, based on the same rationale, why is the Fed not targeting inflation way below 2% to average all that high inflation back down and to deliver actual relief to the American consumer who he claims he cares so much about, right? Oh, we're here to help the consumer with price stability. Okay, well, that means we need lower prices. We don't need prices to go up by 2% a year. We need prices to come down. And in fact, they need to come down by a lot more than 2% a year because they went up by a lot more than 2% a year, right? If prices went up by 6, 7, 8% in a few years, why can't they come down by the same amount, right? I think people would be very happy, would be very relieved if they had that kind of price decline. But no, that's completely off the table. Because as far as the Fed is concerned, it doesn't matter how high prices go up. They always have to keep going up, right? So if we have 1 year where prices go up by 50% in 1 year, the Fed wants to make sure that next year they go up another 2%. So you're at 52% and then 54%, right? We can't have prices go up 50% and then go down by 10%. Oh no, that'd be a disaster. We can't allow that. This is what Powell is saying. That's why it's not that, this 2.5%, 3% inflation. You have to look at it in the context of all the inflation that preceded it. We do need lower prices. We need much higher interest rates to bring the price level back down. Instead, what Powell wants is, he said, it's going to take a while. We need wages to catch up to prices, right? And that way people can afford. So in other words, he wants more inflation so that people can get higher wages to afford the higher prices that resulted from the inflation of the past. But of course, the policies that he is pursuing to increase wages will also increase prices. So it's going to be like a dog trying to catch his own tail. It's never going to happen. In fact, Powell said that the reason they want to cut rates, right? Because he said we're in a good place, but we're in a challenging place. The good place is we got all this economic growth, we got full employment, but he said the risk is to the upside to inflation and to the downside to employment. And therefore, we're kind of, in a difficult spot because, if we want to fight inflation, we got to hike rates. If we want to fight unemployment, we got to cut rates. We obviously can't do both at the same time. We got to pick one. And so this is a difficult position because we're not really sure, which road to go down, right? So anyway, this was more BS today from the Fed. I expect gold to continue to rise based on the back of these continuous string of policy mistakes by the Fed that, is now in a trap of its own design, and it can't escape. And so the result is ultimately going to be a dollar crisis and a sovereign debt crisis. The people who think that you can ignore gold's rally because the bond market isn't collapsing, the dollar's not collapsing against other fiat currencies, that's all wishful thinking. All this stuff is going to happen. The fact of the matter is people are losing confidence in all fiat currencies, not just the dollar. But at some point soon, you're going to see the dollar losing a lot of ground relative to its fiat counterparts. But of course, if you wait for a dollar crisis, if you wait for a bond crisis to protect yourself, you've waited too long. By then, it's far too late to do anything. Right now, you still have the opportunity to protect yourself. You still can buy gold and silver. You can still move money out of U.S. stocks into foreign stocks, into emerging markets. You know what had great day today is the base metals, right? The industrial metals hitting 52-week highs today. A lot of those stocks we own in our strategies. I own a lot of them personally, but these stocks, copper and other metals, just on fire. I'm still waiting for the energy. Energy stocks had a decent day today, but oil's still hanging out around $60 a barrel. There's a lot of people that are bearish on the price of oil. I am not one of them. I am expecting a big move up at some point in oil, and so there's a lot of opportunity in energy.
Peter Schiff delivers a sharp critique of Jerome Powell's monetary contradictions, highlighting how the Fed openly admits that prices went way up and never came down, yet still targets 2% inflation. Schiff argues that if inflation ran too high for years, logic would demand deflation to balance the scales, not policies that keep inflating the problem. Instead, the Fed continues to push rates lower, feeding the same cycle that caused prices to soar in the first place. He warns that this endless pursuit of managed inflation is driving the U.S. toward a sovereign debt and dollar crisis, while gold quietly exposes the truth. Investors still have time, he says, to act before confidence collapses completely, but not much. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.